IPD data has shown that there's been a very strong recovery in the US real estate sector. Pretty fair to say stronger than most other countries that we record, other than perhaps the UK. A lot of the reason for that will have been that, frankly, that the values fell so far during the crash, such that what we're seeing really is a recovery back from those very, very low levels. The sort of numbers that we're showing are that there's a recovery in returns, capital plus income, to investors to the tune of 14.2% last year. But that's following years of minus 20-odd% falls in value, in fact cumulative through the down cycle of nearly 40%. The greatest concern for the US real estate market at the moment must be the patchiness of the recovery. What we're seeing is some good performances on high quality core assets. For example, super regional centres outperforming other retail centres, quality CBD offices outperforming suburban offices. So it's really very much a reflection of investors' appetite for good, strong, safer assets and less risk taking. There's not much activity and evidence of recovery in the secondary markets, and indeed we probably shouldn't expect that to happen until we see either a lot more capital coming back into real estate markets or a strong economic recovery, both of which are probably interlinked. In terms of what the outlook for this year is, the initial evidence coming through from our data is that the pressures on values is slowing slightly, and that returns could well be a little bit lower than the previous year. Of course, if there's a strong pickup in economic activity that starts to improve the demand for space, then we could start to see a more general recovery in real estate values.